All right. Well, good morning, everyone. We have a good group of folks on this morning, and I want to welcome you to another edition of JRBT Tax Talks. My name is Bob Woodard. I'm a CPA and a shareholder here at JRBT in the tax department. I'll introduce my guests here in just a moment, but before I do that, I want to remind you that anything that's presented here today is not considered tax advice. The discussions and the information you receive today cannot be relied upon for any of your personal tax or business tax needs. If you have any questions or need any specific advice, we would certainly ask you to please reach out to your personal tax advisor here at JRBT. But again, thank you for joining us today. And we're here today to talk about sales tax. It's a hugely complex issue for almost every business that we have in the state of Texas. And, you know, it just becomes more and more relevant, more and more difficult for us to navigate through the sales tax rules. And so we really decided we wanted to bring in, we partner with the Michael J. Robertson firm. And today we have Mike Robertson with us and Cindy Alvarez, and they'll introduce themselves a little bit more as they begin to discuss their part of the discussion. But we have partnered at JRBT. We've partnered with Mike and Cindy on a number of projects, and they have been, wow, really, really instrumental in helping us, especially in a sales tax audit, to help our clients and our customers really navigate through the sales tax audit jungle. I mean, it really is. It just, you never know what twist and turn it's going to take. And these two know exactly what they're doing and really are a valuable resource for our clients. And so we certainly appreciate them. And I believe, Cindy, I think you're going to start off today. And before I let you start off, I do want to remind everyone, we are accepting questions, and there's a Q&A button at the bottom of your Zoom screen here. We certainly would love to have any questions that you have. We're going to try and have plenty of time to answer your questions, because we want to know what you have questions about related to sales tax. If we aren't able to answer all questions, because we do have a lot of folks on the line today, if we can't answer all the questions live, we will get you back an email with those questions answered as soon as we possibly can from us, through Mike and Cindy's expertise. So with that, Cindy, I'm going to turn it over to you and let you begin the wonderful world of sales tax.
All right. Good morning, everyone. Sales tax, everyone's favorite subject, right below federal tax. You may think, why do I need to be concerned about sales tax? You might be thinking, I don't collect sales tax. Everything I do involves labor. Did you know that there are 16 taxable services that are just labor? Part of them are just labor. You might be thinking, well, I was told by such and such owner down the street that has a similar business as I am that he was told by the state that he didn't need to be permitted in collecting sales tax. That may not always be the best source to go to. You might also be thinking, I'm good. I remit all the taxes that I actually collect. But do you have those detail records that the auditor is going to want? And what about the purchases? You can think, well, I pay everything that the vendor charges me. If they should be charging me sales tax, they will charge me sales tax. Well, that's not always the case. Did you pay sales tax on the ink cartridge that you might have just ordered off the website? And if you didn't, what do you do? And then also too, what about that plumber that came to your office to fix the sink or the toilet? Was sales tax charged on that? How well do you know the state's statute to feel confident that you are in total compliance for both not only sales, but also the purchases? You know, that plumber that might have come into your office to repair a toilet or a sink, he applies different rules, or he should be applying different rules than he would if he came to your own residence and fixed a sink or a toilet. You also might be thinking, well, I only provide professional services, and I don't need to be concerned about sales tax. Well, did you know that the state of Texas audits non-permitted taxpayers? They will go and audit dentist office, doctor's offices, clinics, lawyers, veterinarians. It doesn't matter whether you're permitted or not. There is a chance that you will be audited. And of course, a lot of the times on these non-permitted taxpayers, the focus may be just on purchases. Now, some people will take the approach that, well, I'll just wait for an audit and I'll let them know whether, tell me whether I'm in compliance or not. Maybe you've been been in business for X amount of years and say, I've never been audited. But could you really afford that $10,000, maybe $80,000, maybe larger bill, just for the wait and see approach? Did you know that there are exemptions for different industries? Are you overpaying sales tax on certain items? What could you do with a little extra cash in your pocket? And then you also might be thinking, I got everything in order. I collect sales tax, or I obtain that resale exemption certificate when needed. And just like I was instructed by my CPA, and we've got everything in order. But if those certificates are not correctly filled out, even with just one missing line item, the auditor can disallow it. And that good faith, when you accepted that certificate as either a resale or exemption certificate, that good faith acceptance is no longer a valid argument. Then maybe you think, well, my CPA handles all of my taxes. I give them everything. But do you really? When you think about what they receive as far as documents to be able to file your income tax return or to do financial statements, may not be the same information that the sales tax auditors look at. Sales tax auditors look at source documents. They look at those sales invoices. They look at those contracts. They look at those purchase invoices. A lot of times, the CPAs will be using the summary documents because that is what is valid for income tax return purposes and financials. They may not necessarily need to see those source documents. So, and in the state of Texas, the auditors, they go against both purchaser or the seller. So regardless if a taxpayer is not charging you tax correctly, if they are auditing you at that point in time, they can set it up on you. So anyway, that's just a few things to consider. I'm going to let Mike talk a little bit more why you should be concerned about sales tax. A little bit about myself, since I didn't really introduce myself, is I have worked for the state for 16 years. During that tenure, I was a supervisor, I was an auditor, and I also got a chance to work down in Austin with the administrative law judges and just the as far as where you write your questions into. And then for the next 20 some odd years, I have been working helping taxpayers as far as their compliance and the sales tax. Thank you.
Mike, there you go. You got unmuted there.
All right. Good morning. It's a great day in Texas. Appreciate the opportunity to talk to you about our favorite subject, Texas sales tax. I work for the Controller of Public Accounts. Last position I had with the Controller was Audit Group Supervisor. And I've been representing taxpayers for 30 years. Sales tax is misunderstood, very convoluted and complex. And sometimes when you call the 800 number, you get an answer to your question, but the way you phrased your question made the person answering your question answer it incorrectly. But what I'm going to do is go a little bit over the normal audit what you can expect from a sales tax audit. You receive an audit notice and several calls from various consultants to represent your business. The fact that you're being audited is a public record, and the public record is available every Monday morning. And these various consultants will go through the audit list, see who's new. They're supposed to wait 5 business days to contact a company, but many times we've had CPAs refer their client to us to represent them for sales tax, and they haven't gotten a letter from the controller's office, but they got a call from one of these consultants. And some of them make it sound like sales tax auditors are to the earth or something. But for the most part, our experience with sales tax auditors is they're doing a job. Most of the time, they're very reasonable. If we provide them with the proper documentation, they'll listen to our arguments. But the time to plan and review records and procedures is when you first become aware of a sales tax audit. Never audited, this will determine if your business is truly in compliance. As Cindy pointed out, many times businesses come up with various ideas as to what compliance is, and will, be performing, maintaining their book that way for years and years and years. An audit period is normally 4 years, which is a long period of time, but it can be 7 years without front office approval if the manager of the audit office feels like it needs to be extended to 7 years. And in some situations, it can be from day one. One audit I had was for 15 years, which was from the first day they incorporated in Texas and went forward. But that one ended up 4 years, and then we negotiated it down a little bit from there. And if it's a prior productive audit, which means if it was prior audit was $25,000 or more, then the client will be audited again within 3 years, which sometimes can be very bad because the errors that created the original liability that was greater than $25,000 were probably still in effect from the end of the audit period until the audit was finished and the taxpayer, our client, knew what they needed to do to be in compliance. But then sometimes they misunderstand what the auditor told them. An example is an automobile repair shop. Okay, it's one of the areas of tax law where there's a few different twists. And one of them is if you're repairing a motor vehicle, the labor is not taxable. So the repairman can lump sum the repair, buy the parts, and because it's a lump sum, the repairman is the consumer and should pay sales tax. Sometimes the repairman will separate the invoice, put material, parts, then labor and tax. But if unfortunately they didn't realize that they had to separate the material and the labor before they could charge tax on the material and remit it, the state calls that error tax. That it was a lump sum repair because it was not separated. And it has to be separated correctly. In other words, the material, parts amount, labor amount, and sales tax, but it has to be obvious that the sales tax is only on the material or the parts. That can either be with a T to the right of it, which is what QuickBooks normally allows, or somewhere at the end of the bottom of the invoice, parenthetically, it says tax on the amount, which is the labor, not the labor, the material and the parts. Also, because it's 4 years, where are the records? Are the records in good order? Can you find them? Have the rats gotten into the records? Many, many things can happen. And most people don't realize that sales tax covers such a long period of time. And the fact that the auditor has to look at invoices. They cannot determine by a credit card statement or a statement from the vendors that sales tax was charged and paid, because those are usually a lump sum amount. So that's a problem. And if you can't provide the records, the auditor says, well, I wanted to see these invoices for sales, these invoices for purchases. You don't have those. So we're going to say those weren't taxed. And that's
Mike, real quick, I just want to kind of jump in and say, you mentioned credit card receipts. Some folks think that an invoice is if they just keep their credit card statement, that they really have the invoice and the actual data the auditor needs. But you said there that wouldn't probably be sufficient, right?
That is not sufficient. It may be sufficient for federal income taxes, but for sales tax, it's form over substance. The auditor has to look at either the original invoice or a reproduction of the original invoice, whether it's a sale or a purchase. And that really puts a burden on the business, because maintaining the records takes time and effort and doesn't produce any revenue. There's no sales there, but could save a tremendous amount of money if those are maintained. And also, what Cindy was saying earlier, it's important to understand that not every business is sales tax the same way. As I pointed out a while ago on the repairman, it's just the nature of the tax law. Sales, again, is form over substance, and the auditor will look at a sales to determine if sales tax was charged, trace the sales tax collected to the sales tax liability account. Then they take the liability account to make sure that all the taxes collected were remitted to the state of Texas in a timely manner. Many times people don't check that. They don't realize that, well, we thought we were paying all the remitting all the sales tax we collected. Sales tax is a trust fund, just like payroll taxes. And if you don't remit it, the auditor finds it, depending on the severity of it, there's a possibility that it could be an additional penalty. Additional penalty is 50% of the tax and the 10% statutory penalty. So that makes it very important to make sure that you're in compliance. The auditor will they'll reconcile your sales to your sales tax reports, to your federal income tax, to your franchise tax. So, okay, your sales you reported for sales tax purposes, your monthly or quarterly reports, is $100,000 less than the sales that you reported. What's the difference? Well, if you can't prove up what the difference is, that's additional taxable sales. They'll look at your capital asset purchases. Now, the assets that they're looking at are the assets within the audit period, whether it's, normally it's 4 years, and you have to have an invoice for those assets. And many times a business didn't realize they needed to keep the asset purchase invoice, so they don't have it. Again, the auditor says it's taxable. And some of the assets, if it's a manufacturing assets are exempt by law. And those, you depreciate those assets, and you can prove up that it's a piece of manufacturing equipment that qualifies for Rule 3.300, then usually the auditor will accept it and say, no problem there. And they look at the expense purchases to see if you're paying sales tax on your expense purchases. Now, since the Wayfair Act, that's pretty much going away, because there's 45 states that have sales tax. That includes Texas. And they're becoming more and more aggressive about making sure that sales that businesses in their state into Texas or the other states, that the sales tax is being charged and remitted to that state. Some of the unusual things you might run into is like in the cost of goods sold. They'll review the cost of goods sold. If you're a manufacturer, you can purchase wrapping and packaging with a resale certificate. But if you're buying and repackaging and selling the product, that repackaging is not. And we've had several clients that did not realize that they were considered repackagers and not manufacturers. So therefore, they had a liability on those purchases. And most auditors don't look for overpayments. If they do find an overpayment, they may or may not schedule it. Normally they will. But it's up to really the business or the professionals that are working with the business on sales tax matters to determine if they're overpaying their sales tax. Then most people will call the 800 number. Most businesses, I should say, will call the 800 number and ask a question. Then they'll receive an answer. And we've had many clients tell us, well, I called 3 times and got 3 different answers. Well, it's the way the question is structured. If you don't use sales tax language, then you might get the wrong answer. Plus, if you get the wrong answer, you're not eligible for detrimental reliance, because you normally can't prove up that you got this answer on this date from this person, and this is your question and this is their answer. Although there are times when we have been able to use detrimental reliance because of other circumstances and facts. One was a automobile repair shop, body shop. They purchased another body shop, and that body shop, they were doing web file, and it was set up without local taxes. Well, in reality, the local taxes did apply, and the client had about a $65,000 liability. And so I argued that the client didn't set up the sales tax. The state set up the sales tax. So when I was talking to the attorney for the tax division, he said, well, what do you mean? And I said, well, go talk to the people at tax policy and see what they say. And so about a week later, he calls back and says, okay, we're going to delete the audit because it was set up wrong. So there are times when the state does make a mistake, and you as the taxpayer can benefit from that or minimize the liability. But all this being said, is sales tax is different. And if you use common sense and logic, it's probably a good possibility you're going to be wrong. And that's what Cindy and I, Albert and Guy, are trying to do. We're trying to level the playing field for the businesses out here. It's hard enough. And, with a 4-year audit, the liability can be huge. Now, what Cindy was saying, 30, 80,000, I've seen people that mow lawns with $130,000 to $150,000 liability, and that was taxed. If they had collected and remitted, there'd be no problem, because they did not know to collect sales tax. They have to pay that liability out of their pocket. As Cindy pointed out, the state proceeds against either party until the tax is paid, the purchaser or the seller. And but that's we'd like to have some questions to see what.
Okay, yeah. So Mike, the first question I'd like to ask you is in the chat, and the person in the chat has asked that their organization files sales tax returns based on reports provided by a contracted third party who handles our sales for a segment of the business. So we have a third party who's kind of handling the sales, but they're getting the information from them. So in your experience, what type of sales tax records should they be maintaining, and what should be maintained by the third party? I'm not sure if we may need some more clarification on that, but have you seen that happen where you've got a business that's kind of part of their sales is handled through a third party, and that they're responsible for collecting and remitting that sales tax? Have you had that experience with some of your or something similar?
Mainly something like Amazon, one of those internet sellers.
Mm-hmm.
They're real good about handling the sales tax properly, whether it's Texas or any of the other 44 states. I've never had a local business that did that. I think all of our clients administered their own sales tax reporting responsibilities.
But thinking about that, if we have someone who does have a third party, what records should be maintained? I would think they would need to get a copy of all the invoices that third party, if they're sales tax related and it's their sales, I would think they would need to retain a copy of those invoices that were sent to customers, because that's their sales. Even though the third party is kind of sending out the invoice, that's still your sales if it's on your business and under your business name. I think you need a copy of all those invoices that are sent out, detailed invoices.
I believe, I've been told that is, that whoever that third-party seller is, they forward a copy of all the sales tax returns that they prepare with detailed information.
Mm-hmm. Yeah.
But yes, you should maintain your own source documents. You should have those documents because you're going to have customer names, addresses, whether tax was charged or not. So that's the only way you're going to be able to verify that is by the actual source documents such as sales invoices.
But I believe that's what they're getting when they get the sales tax report. Let's say they got Texas and 3 or 4 other states that they file sales tax in. And so the vendor, like Avalar, sends a copy of the sales tax report with all the detailed information, what you just mentioned.
Mm-hmm. Okay. All right. I know Cindy kind of talked a little bit about it, but I know a lot of our clients in the past with those audits, they may be doing a pretty good job with their sales tax, may or may not. Let's just give them the benefit of the doubt that they're doing a good job on collecting and remitting sales tax on their sales. But the use tax is something that the auditors really focus a lot on. And my experience has been with our clients is that those sales tax audits, the use tax can be as much or well more sometimes than the sales tax, just because of just not paying attention to those. Can you address maybe some high level thoughts or policies or procedures that clients could really think about in the use tax situation before an audit, so they avoid these kind of huge adjustments?
That's a very good question. They should maintain the records. And again, a lot of this adds to the work of the business, the accounting staff. Mm-hmm. They got one person in the office that's doing everything. I would suggest that they maintain a copy of that invoice that they've accrued sales tax on with their sales tax report. And as Cindy mentioned, the doctors and the dentists and those type of professional businesses, those are use tax audits. They're looking to see if they've been buying something and not paying sales tax on it. Maybe thought that this piece of equipment was not taxable because they were using it for XYZ. Also, what you're talking about is on expense purchases, it's going to be a sample and projection. And if your sample is large and you have a few errors, it can result in a sizable liability. I had a new car dealer that had 3 invoices, and the tax on the 3 invoices was less than $1,000, and the liability was $30,000. And I kept looking at the invoice. I said, "What is this invoice?" And so I started calling around. It wasn't a purchase; it was a donation, and that cut the liability in half.
So what you're saying there is they pick three invoices or 10 invoices that total up to $1,000, but supplies expense is $1 million. They're going to extrapolate. If they find one error out of that 10,000, then they're going to extrapolate that error. One error must mean that for the whole $1 million, there's the same amount of errors. And so even though it's only $100 in sales tax you missed, when you extrapolate that out to the million, they're not going to look at every invoice in supplies. They're just going to look at a few. That may extrapolate out to $30,000 in tax, which is obviously not ideal for our businesses.
That's true. And that's the only way the state can audit the number of taxpayers. And it's not a statistically valid sample and projection. You can't beat it. I mean, the state, they will fight you forever. And it really frustrates a lot of our clients because they're going, well, just a couple of errors. Why don't we just tax those errors? We'll barely pay the $1,000.
Yeah.
And also in that automobile, the new car dealership, they fell under the $25,000, which represents a prior productive audit. So if an audit results in something over $25,000, they'll be audited again in 3 years. So that dropped it down. they haven't been audited since.
That's good. That's good.
Something
We got
else
a couple-
that something else that people can do is, I mean, as far as the purchases, you know, see if tax is charged or not. If it's not, you know, you may want to look at it to see if it is some type of service. If it's from out of state, then that could be a red flag, even though we've got the Wayfair and then there's going to be more out of state companies collecting and reporting. You're still going to have a lot of out-of-state purchases that have not been taxed correctly, and you are responsible for reporting that use tax. Make sure you keep those contracts and those agreements as far as exactly what type of service is provided, because we will get questions all the time, you know, well, is this taxable? And I usually typically always have to say, do you have an agreement? Do you have a contract?
Right.
And then let me look, and I will do, you know, research on their website to see what type of services they provide. Are we talking about a non-taxable service, or is it going to fall under one of the taxable statutes?
Okay, excellent. Well, since you mentioned Wayfair, Cindy, I'm going to kind of keep, there's a question that we have in the Q&A, and it's talking about Wayfair, the Wayfair decision, which is obviously a monumental decision in the tax world between states. And for those who don't know, probably most do, but Wayfair is the furniture company, and they, state of South Dakota, decided they should pay sales tax even though they didn't have any presence in South Dakota. Used to forever and ever, if a business didn't have a presence in a state, they weren't required to collect and remit any kind of taxes for those states. Well, the Supreme Court basically decided with the internet and the advent of the internet and websites that kind of expanded our quote unquote nexus rules, which means that you're doing business. So Wayfair, even though they didn't have a distribution center, they didn't have any kind of showroom, anything in South Dakota, they were determined to owe South Dakota sales tax. And what that did is that expanded the whole 50 states. When the Supreme Court ruled that, that means now that if you are a business here in Texas and you ship you know, product to South Dakota or really almost any other state, and unfortunately every state's different, so we can't answer the specific question here, I know, but we're going to get at some generalities. You are probably, if you get to a certain threshold, and every state has a different threshold, whether it be $250,000 of sales or $100,000 of sales or a certain number of sales in their state, you have to collect and remit sales tax on behalf of South Dakota and Tennessee and Georgia and Alabama and New York. And so the question is, that's really burdensome for a small business because, as I think Mike mentioned, they may have an accounting staff of 1, 2, maybe 3 people, but that's really burdensome if we're doing a lot of out-of-state sales. And so the question is, do you guys recommend that they hire a third party like Avalara? And I know that company was mentioned, and that's just one of the companies that does sales tax compliance for businesses, or allow the CPA to handle registrations, filings, or that, and keep it in-house. What do you guys, if you guys have much experience? I know you mainly deal with Texas, but I know you're probably having to expand a little bit more to other states too. Is that a fair question? Should they be using Avalara, or should they be kind of handling it on their own?
That is that is a very tough question, because I mean it really depends on, you know, how many you have to be able to handle this. Mm-hmm. Yes, I would definitely reach out and seek help as far as what states that you do need to be permitted in, and yes, get registered in those particular states. Now, hiring of the third party service like the Avalara, you got to, like say, weigh the cost versus the cost of hiring possibly additional people to handle those additional states that you have never had to report into.
Right.
So there's really no good clear answer on that.
I think they should start.
Bob, I don't know how many clients you have that you are helping set up in other states. I imagine quite a few.
Yeah, I would. My recommendation would to them as their CPA, and they need to call their individual CPA. I think that's really the bottom line. The first phone call needs to be to your tax advisor, and so then kind of explain the situation, figure out, does it make sense that if it's 1 or 2, if it's just Oklahoma. I mean, maybe we're going to Oklahoma and selling. That's pretty simple. We probably could help you do that. But if we get to multiple states, we're getting to where we're in 20 and 30 states, you know, we probably need the assistance of a company or someone that specializes in the multi-state filing and handling the compliance, because as you guys mentioned, you got to keep the compliance, you got to keep it separated, you got to keep it in the right place, you got to know what state it goes to, and really not even every state. You know, I mean, in Texas, you have there's hundreds of jurisdictions that have different state rates, and you've got to know what those rates are based on a zip code and based on all kinds of things. And so it gets very complex, and we really but start off with your tax advisor, and then we might need Mike and Cindy and their firm to help with some of that, and we might need to go with them and with an Avalara. So I think it's a great question, but it is something just you need to recognize. If you're sending product out of state, you may have some other issues of state sales tax, and all those states are grabbing for money. So the other states are grabbing for money, and if you're a taxpayer in Texas and they can find you, you know, if California finds you in the state of Texas, you don't vote in the state of California, so you have no say-so. So they can pretty much jump at you and do as much to you as they want. You can't have any real recourse. So just need to be at least aware of the compliance issues for sure. Absolutely, absolutely. Anything else on the Wayfair that y'all wanted to because I got a couple other questions. Okay. So the next question was the services for household, parts, labor, is service taxable? I'm not sure if you guys can see that on there. I'm not sure exactly what that question, it may need a little bit more detail, but household parts and labor divided. I think that maybe mean for maybe I'm just extrapolating, maybe construction for home, you know, household construction.
It could be maybe when I mentioned the plumbers.
Yeah.
You've got a repairman coming into your residence, and what he will do there is, if it's going to fall under particular rules, going to fall under 3.291, the contractor's rule, which also applies to new construction. You have a choice of how you want to bill. You can bill separated, meaning you bill separate amount for your materials and parts and a separate amount for your labor. Only the parts is what you will be charging sales tax on and then reporting that. Now, the other option is lump sum. You can be a lump sum repairman for residents and new construction. And that means that you are the consumer of those parts. So you would be paying tax when you purchase those materials and parts. And then the full amount that you're charging your client, your customer, you do not charge anything. The caveat on that is, all of a sudden you're going into a commercial building. Well, commercial building, it doesn't matter how you bill, that full amount is going to be subject to sales tax. So that is how a particular service provider can start getting into major issues if they do various types of service for different industries. Yeah.
Okay. Definitely, it makes it confusing. That is for sure. So the next question I see on here is, how long should businesses and the individual sales orders, invoices, all those details, even invoices for use tax, how long should we keep those? So as a business, obviously you don't have to keep them forever, but is it 7 years? Is it 3 years? Is it 4 years? 20 years? What would be y'all's recommendation?
I believe 7 years would be appropriate because that covers the federal and the state for the most part.
Yeah, I would agree with that. Yeah. I would definitely. 7
years.
years.
Also, going back, one thing that we didn't talk about is the hierarchy of documents, what rules, the contract rules. If it's contractual obligation, it doesn't matter how they're invoiced, if it's a construction job, a pay app or whatever, but you want to make sure that the contract is clear, that this is new construction, that the lump sum new construction or separated new construction. The new construction can include adding additional square footage to a building. And in the rule that Cindy referenced on contractors and repairmen, there's called the 10% rule. So you've got, let's say, $1 million contract, they add new square footage to an existing building. Okay, that new square footage is new and it's a lump sum contract. There's no problem there, but there's a cost to attach it to the existing building. But it wasn't delineated in the contract. There's nothing mentioned about the remodeling part. And let's say the remodeling part was $60,000. Well, that's greater than 5%. And the state takes the position that it's 100% taxable.
Wow.
So
Wow.
that can really hurt.
Yeah, we got to be careful in how we do our bids and our invoices and things like that. One question I wanted to ask you guys is about if I'm a business and I've got a target, an acquisition that I want a new business that I want to acquire. So I'm looking at, it's an existing business and I'm looking at acquiring, I'm going to buy that business. Are there sales tax issues I should think about when I'm buying that business? And what should I do about it?
Well, Cindy just had that, so I'll let Cindy answer that.
Okay.
If you're yes, if you're acquiring a business, you need to have that business get a certificate of no tax due for both franchise, clearance certificates for franchise, certificate of no tax due for sales tax, because you could have possibly successor liability, to where an auditor can go back further than when you actually purchased the business. So certificate of no tax, when you're out there acquiring businesses, you need to get a certificate of no tax due.
And I would assume you would want to have that certificate or some similar certificate for any business, any state that company is doing business in. So let's just say that company is doing business in Texas, Oklahoma, and Florida. You probably would want to have them get a certificate from Oklahoma and Florida in addition to the state of Texas. Correct. Yeah. So, I have heard a horror story just a few months ago of a business that a company that was trying to sell their business. So this was the seller side. They had about a family business. They're going to sell it for about $8 million. They had it all done. The due diligence was done, and they came in and found out they had a very large sales tax exposure because this company had not handled sales tax properly, and the whole deal was called off, no sale. And where the seller was retiring, he really wanted to retire. It really hurt, and he ended up selling the business for about $3 million less because of sales tax on that one issue. So it's a significant deal, even if you're buying or selling. If you're buying, you need to have that certificate. If you're selling, you need to know your sales tax is in order before you really go out to sell that business, because it'll affect the value.
Yes.
Yep. Okay, I do have a couple other questions. One I want to address, and a couple of them we may just send an email, because I don't want to go on too long with our webcast. But what we have here is we have a Texas software company, so a company that's in Texas selling software to customers in multiple states, and we collect sales tax from our Texas customers, but we're not collecting sales tax from the other states. This is, by the way, anonymous, so nobody knows who this is. If audited by the state of Texas, will that auditor share the information with other states, i.e. with Oklahoma or Tennessee? Will the state of Texas let those other states know, by the way, there's sales in your state from this company?
Normally it's picked up when they're auditing the company, let's say in Oklahoma or California. They say, okay, this company is not charging sales tax. So they possibly include that in the audit of let's say it's a California company. And then California will contact the company in Texas and determine if they should send an auditor to Texas to do that. Unless Cindy's had experience with that, I've never had an auditor refer an audit lead to another state.
I've never seen it.
Yeah. In Texas, the audit leads are mainly in the comptroller's department. Okay. They find a company that wasn't charging sales tax properly. So that auditor sends the audit lead out and says, hey, we need to look at this company. And most auditors, I think it's most, don't send audit leads. some do. And then it depends on if whoever's reviewing the audit lead believes that, yeah, this is one we need to go check out.
Okay. Yeah. Like I said, there are a couple other questions, but I wanted to really take an opportunity to first tell our audience that, like I said, as I said at the beginning, at JRBT, we have used Mike and Cindy and Mike's firm there to help a number of clients in a couple of different ways. One, we've been talking about that is sales tax audits, and they do a fabulous job of helping you navigate through the audit process. And so we've had some great success with that. And it doesn't mean you're not going to owe sales tax, because let's be honest, sales tax is confusing, and we as businesses don't always do it right. And that's why we have audits. And so, but in minimizing and making sure that the auditor asks the right questions or is given the right answers to their questions, because the problem we have many times with clients and businesses is you know how to run your business. You don't know how to talk sales tax. We know how at JRBT to talk federal tax, state income tax. We're very well versed with that. We know enough about sales tax to get by, but we don't know all those ins and outs and the details. And Mike and his team, that's all they do. That's their passion. That's how they help Texas businesses is doing that. So, but another area that I would like to ask you guys to talk about is not in the sales tax audit, but I'm just a business out there and I'm concerned that my controller, or I'm the controller and concerned my owner is not really handling sales tax right. We've been in business for 20 years and I'm really concerned about it. Are you guys a resource they could use to kind of help do an assessment? You guys do that for clients?
Yes, we do. Yeah, we call it a checkup. Yeah. Just like, you go to the doctor and the doctor says, well, you need to go to this doctor over here. He's the one you need to go to get the checkup. Right.
And so that I guess that really is almost like you're almost like doing an audit without the state knowing about it, and kind of telling people where they're deficient and how they can get back in compliance. And do you find that when you do those, you usually find some things that folks need to change? And what would be a couple of the biggest ones?
Well, Cindy, you and Albert did one. Did you find anything on that one?
I don't know which one you're talking about.
The checkup.
I've gone out and done several, and, and I've gone out and seen where people have, overpaid also. And they're like, well, we don't want to send, any information in because we don't want the state, to come see us. There's, different ways of handling that. But we can go out and fairly quickly let you know, if you are in compliance for both, your sales and your purchases, without having to get into a whole lot of the detail on the purchase side, as far as like a lot of service agreements. We can look through your records and be able to identify where you have tax exposure.
Right. Well, is there any other topics that we didn't discuss that you guys wanted to make sure we hit? I think we've hit a lot of different topics, but the problem is sales tax. We could probably talk for about 8 hours and we wouldn't hit but about 5% of them. So it doesn't sound like we have it. So what I want to do is kind of wrap up again. First of all, I want to tell Mike and Cindy, thank you so much for joining us. Again, it's always great to partner with experienced, qualified, and ethical firms like yourselves and people like yourselves to help our clients. What we're trying to do is make sure we get the best answers for our clients that we can. And guys out there, your sales tax is something that we don't think a lot about. It's just something we just kind of set it up back when we organized our business, and you really need to take an assessment. So whether you're a controller, whether you're an owner, whether you're in the accounting department, it's something you probably ought to take a little bit of an assessment, figure out where are we with our sales tax. We haven't really paid attention to it in 15 or 20 years. We just keep doing what we've been doing. And that may not be the right answer. We may need to do that. So I would really strongly advise folks to reach out to their tax advisor. And if we need to get Mike and Cindy involved, we absolutely will, because they do a fabulous job, and their whole team, as I mentioned a couple other names, their whole team does a good job with that. But we hope we answered a few of your sales tax questions. we know we didn't hit all of them. We know there's no way we can do that. We just want to kind of address that and kind of expose everybody. So with that, I think we will kind of wrap up and we'll finish. But again, Mike, Cindy, thank you for your time and your expertise.
Thank you.
All righty.
Appreciate it.
Absolutely. Everybody have a great day and enjoy this nice spring Central Texas weather. Bye-bye.
Thank you.